Welcome to the Expert Network Team podcast,
where our goal is to inform and educate our listeners on matters related to finance, legal, insurance, accounting, and other interests that are of personal and business nature.
We hope you will find our content useful as well as entertaining. The Expert Network Team consists of Carl Frank of A&I Financial, Mike Miller of Miller and Associates CPAs, Jeff Krommendyk of Security First Insurance Agency, and I'm Nathan Merrill. I'm an attorney at Goodspeed and Merrill.
Together, our independent team combines our expertise to provide you insights and solutions, some straightforward, some profound, for real-life opportunities we see on a daily basis. We hope you enjoy the information contained in today's podcast and find it useful. If you'd like to learn more or desire to meet with any of the Expert Network team members in person, you can contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
And we encourage you to take advantage of a free consultation with any of our team members. Just mention this podcast when you schedule your appointment.
Now on to today's podcast. Welcome to today's podcast. I am Nathan Merrill, and we are without our fearless leader, Carl Frank, today. But in the room, I have with me both Mike Miller of Miller and Associates CPAs.
Gentlemen.
And I also have our star of today's podcast, which is Jeff Krommendyk of Security First Insurance Agency. Star?
Oh, my.
The pressure's on.
Yeah, you've really set the standard high.
So now everybody's really anxious to know what we're talking about today, so I'll just lead in with that. What we're going to be covering are a few things for our guests today, or for our listeners today. The first is just to discuss some of the ways in which folks may want to relook or revisit their insurance coverages, just to make sure they've got everything covered. We'll talk everything from rising house values, property values, and some of the other ways folks are used to covering their exposures, and then some of the way those traditional ways of covering exposure are changing. And then we'll move into business risks and ways, given the some of those changes, how we can address their exposures both through the legal and insurance areas. So without further ado, I'll kick it off to Jeff, and I'll lead him with this question. You know, what should folks be concerned about or looking at, given the type of general rise in property values and that sort of thing that we've seen recently, especially here in the Denver area?
Yeah, thanks, Nate. Mike, good to see you.
Thank you.
Thanks for being here. You too, sir. Yeah, we are missing Carl today, but he'll be back with us soon, I'm sure. Listeners, thanks for, again, tuning in. And this is something that has kind of been rising in conversation here among the four of us in the last several weeks. And we certainly are in, I guess I'd like to say, unprecedented times. I don't remember a time in my career over the last 28 years where we have seen not only property values, but even building costs increase by multiples like we've seen here in the last 18 to 24 months.
Sure.
And
everything from supply chain to labor shortages to just underlying property values have gone up, haven't they?
Again, across the board, really. And again, when we talk about, insuring our assets or managing our risk, there's really two valuations out there when it comes to evaluating property values that we do keep an eye on as homeowners, building owners, business owners, and that's, first of all, the real estate values have gone through the roof in not only Denver, but I would just say across the nation. So regardless of where you're listening, I think that's been a pretty safe assumption. Maybe not in some other, areas, but for the most part, real estate values have been up, which is like basically
Kiowa,
a market.
Colorado might not have to worry about this.
I think Kiowa is actually very, very attractive, and I'm sure they've seen appreciation there as well. But
no offense to our friends in Kiowa,
right? Real estate values are something as owners we really do tune into, but from an insurance or risk management perspective, we really set that evaluation aside and really stay focused on the replacement cost value, which is in essence the building materials, labor costs, really everything it's going to take to, in essence, rebuild a structure. And that too now has absolutely gone crazy with regards to the supply chain issues as well as labor, shortages and things like that. So that's really what I would like to just kind of draw our attention to today. Put the real estate valuation aside for right now because we're most interested in managing, when we manage risk, to really insure for what it would take to rebuild the structure.
So if what I hear you saying is, if I can restate that to make sure I'm understanding correctly, because of the way the market is impacting real estate values, that may not be a true indicator of how much you actually need insurance for. So you may be looking at your Zillow valuation and it's $800,000, but to actually rebuild your structure, it might be more like $5.
You got it. Absolutely.
Okay.
That's a pretty good assumption. We have had markets in the real estate industry where actually, especially in commercial markets, where actually the building, it would take more to replace the building than it would to sell it. Actually, the sale price would be lower than what the replacement cost on the structure would be. But that is not the case right now. We are inverse of that for sure, and that's usually the case for homeowners in real estate, where the real estate value, the sale valuation is always usually higher than the structure replacement.
Right.
And that's because obviously you're buying market, you're buying location, school districts, and also we're not going to replace the land, right? We're just going to be rebuilding the
building, right?
Yeah.
So, and then keeping in mind that, in that hypothetical, working our way backwards from an $800,000 valuation to a $500,000 replacement, that person may have bought their house for $250,000, 15 years ago, and they've not looked at their insurance since, right? Is that fairly common?
Yeah, it is, unfortunately. And, the insurance industry has done a relatively good job in really building some nice features into homeowners' policies that actually does allow, or the policy will naturally, every year at renewal, increase the property value, or in essence the coverage A limit, which is the dwelling limit. It's the coverage on the structure of your home, and they'll do that by typically an amount of about 3 or 4% per year, which is what we call an inflationary increment. Mm-hmm. Understanding that, that home's going to be a little bit more expensive to replace this year than it was last year.
But we've been going at clips of 7, 8, 10%. Right?
Exactly. And so, hence the reason for our topic today, just a reminder to all you homeowners out there. And I would just say, real estate investors or commercial real estate owners even, that it's important to take a look at these building values, home values. It's the time is now to really do a good deep dive and review that, and because again, our replacement cost values and certainly the cost to rebuild structures today is considerably different than it was just 12 months ago.
So before I throw you a curveball, because I know it's not on the agenda, but I just had a kind of an epiphany, and I know you'll be able to answer it. What about contents? I mean, what's the approach, or how should we look at? Are contents covered in that rebuild, or how do you handle your computer and your furniture and your appliances and all that fun stuff?
Jewelry, things like
Jewelry,
that.
Yeah, right. Yeah, good question. Actually, the contents are a separate limit. Would be a coverage C. Actually,
that's usually wrapped into a traditional home policy.
It would be,
okay.
And it's usually a certain percentage of your dwelling limit, which most policies are going to typically be right around 75% of your dwelling limit for contents. I've seen some policies out there at 50%. And that's really just kind of an automatic limit then that typically is more than enough for somebody with that size of a home. To Mike's point, just talk a little bit about jewelry. That there's an exception there for specific types of personal articles, and jewelry is certainly one of those. If you have an extensive amount of jewelry or maybe one piece that's valued, I would say over $1,000, I would just make sure that you make let your homeowner's insurance agent know that I do have some items that I'm particularly concerned about, whether it be fine art, jewelry, any type of collectible such as sporting cards or sporting memorabilia,
books, antiques.
Yeah, antiques. Even sporting goods. There's no such thing as
Drum
$1,000
sets,
bike
pianos.
out there. Yeah, exactly. Instruments are good, but always have a conversation around those because those are usually very unique. And they're oftentimes, one of a kind, and they very well may grow in value. Whereas most of your common
like
personal
my tube
property,
sock, my
yeah,
tube
that's
sock
going to
collection.
decrease in value as you wear it currently by the minute. So, yeah, good question.
So, what about the frequency at which you should shop your home insurance? I mean, we're talking about now being an important time to take a look at it. But, I know folks who will shop their car insurance every few years just to make sure they're getting the best rates. Does the same rule apply to home insurance? Because I honestly can't think I've never gotten my home insurance requoted, except for maybe when I had you take a look at it once.
Yeah, I would say it's good to definitely keep your carrier, honest for sure. I mean, the markets are shifting constantly, and insurance companies, are really taking different positions in the market at all times. There's carriers out there right now that feel like they have an opportunity to gain some market share, and so they'll cut rate and gather some market share in number
kind of like banks do with loans,
zip codes. Yeah.
We're looking for these kinds of real estate loans. Yeah, there you go. And this is how you know that Jeff is an ethical insurance agent, because he didn't just say, "Yeah, you should reshop it now and give me a call."
No, that's okay. I really do believe in loyalty, especially when it does come to insurance companies. So you don't want to be jumping ship every 6 months or every 12 months even. I think there is a lot to be said about staying put. Really letting that insurance company gain some loyalty in your world. It does help. We as insurance agents can get some concessions on occasion with regards to underwriting guidelines if we have some longevity with a carrier, or not saying that a claim goes better if you've been with a carrier for a long time. That's not always the case, but we can definitely see carriers respecting and really honoring loyalty. So that's good. Yeah. But I would just say, the market shifts on a regular basis, and, to maybe kick the tires on insurance or home and auto insurance, maybe every 3 years at the very least.
Least frequent.
Yeah.
Okay.
And, I wouldn't, really suggest you just kind of turn a blind eye to it, in the year 5 or 6. I mean, definitely get out there.
Now this will give some color to that as to kind of what triggered my thought, because this is also a segue to my curveball question I'm going to throw at you, which is we now officially have shipped off. I know Mike's done this a couple times, shipped off a child to college, and so he's no longer in our household, and he's driving a car, and he has renter's insurance and all stuff. So we basically set him up with his own insurance. So I'm sure there's a lot of folks that are kind of in that transition period that maybe you can speak to that, give them some counsel. But to that point you just made, as I was working on getting him set up with his own car insurance and everything, because it's different state, all that stuff, they're like, "Thank you for being a XYZ insurance company customer for the past 35 years. I'm like, wow. We've been on this insurance since my wife was like 16 years old, so...
Right.
Yeah,
absolutely. Well, I think...
I guess that would make it 34 years.
Yeah.
No, 10 years. No, I'm just kidding. I don't want to give away her age.
I wasn't born yet.
Yeah. Well, it's probably time to look at that, Nate. So
we've looked at it a couple of times. We just never moved.
Yeah, right. Understandable. So just with regards to kids that are transitioning out of the house, I would a couple things. First of all, if you're sending them away to college for 9 months, and you're not sending a car with them, most insurance companies will want to know that, so that they can take them actually, just reduce their rate by knowing that, hey, look, they're not going to be driving, but maybe a couple weeks during Christmas, and then again maybe at spring break, and then maybe 2 or 3 months during the summer. So there's a 4-year period there, or 5 years some kids take, or whatever it is, that certainly you want to just make sure that the insurance company knows that they're away at school without a car. Now, usually year 2, you do send them with a car, and then in that case, it's important to let the insurance company know again that they're now driving, they've got a car on campus, and again the insurance company will apply the appropriate rate.
One thing that got him turned around a little bit was I own the car, but he's driving it, and they wanted to put me on the insurance too as the owner. Is that pretty typical? Or
yeah, very much so. And so just speaking to that a little bit, really you can keep your college or your college student on your insurance through their college career. I mean, until they actually graduate and are no longer going to school and are living outside of your home. That would, in essence, be an underwriting trigger that would say, okay, it's time for that kid to get their own insurance. So you may have jumped the gun a little bit the way it sounds, Nate.
Yes and no. I mean, maybe you can speak to this. So we can just give me as the case study here. So, as you know, I like cars.
Yes, you do.
So I have a few of them hanging around the house. And as I understand it, if you're in the household, you're deemed to be able to drive any of those cars.
Correct.
And he's a teenager, and there's several in that collection that are high-dollar cars. So actually taking him off reduced our premium on him and the household premium because he's now not deemed to be driving 4 different cars, 2 of which are collectibles.
Yeah, great. That's definitely a good strategy, I think, in that particular case. That's not most people don't look at it that way, but I think that's really good. With that said, then when it comes to getting your son that insurance, it's important that he's either a co-title or a co-owner on that vehicle, or the sole owner. And this kind of brings up another insurance question, which maybe we'll get to, maybe we won't. But insurance is to insure a piece of property, you have to have insurable interest in it, right? So it's very important that that auto policy actually align with the title on the vehicle. And if it's Nathan Merrill, that's the owner of the vehicle, then Nathan Merrill's got to be at least a named insured on that policy, and probably a driver as a result, which I think could help because the insurance company is actually going to pull your credit. Oh, okay. Well, hopefully you have better credit than your son.
I do have better credit.
But maybe not a better driving record.
Yes.
Okay.
Maybe we can put my wife on it.
Oh, there you go. I'd do that. Yeah, so just keep that in mind. We want that title to really align.
All those
with
accidents and tickets will fall off. How many years do they stay on your record? 5 years?
Well, if it's a major, like probably you have, like speeding in excess of 20 or 30 miles an hour.
Yeah, but it was Wyoming, so it doesn't count.
Well, it's probably
No, it wasn't 20 or 30. It was like 10, but that means I was going.
That's fine. 3 years.
90 miles an hour.
3 years in Colorado. So.
3 years. Okay. Oh, geez. All right. So, do you have anything you want to?
Well, I was going to come back to the collectibles piece. Like if you have art or you have sports memorabilia or something like that. So you've got a Babe Ruth baseball you bought 20 years ago for call it $10,000. That's worth $10 million now, and all your paperwork's in the house, and the house burns down. What happens?
Yeah, really important for items like that you get a copy of the appraisal or have an appraisal done, so you have some documentation that this is what it's worth. And then make sure that the agent or the insurance company has that documentation on file as well. And then in that process, the underwriter will agree to insure it for that value and charge you a premium accordingly. So really that's kind of legwork and paperwork that needs to be done when you add that baseball to the schedule to, first of all, get the underwriter's approval to insure it for $10 million. And second of all, make sure that they have a copy of that appraisal. So if you do lose the appraisal, there's proof.
And I just know a lot of people just have their documents in their house, in a filing cabinet. Poof, the house goes up. They lose. They don't have any documents.
I know some people like store those in the cloud or something like that, or e-money if you work with an advisor that uses e-money or something similar where you can upload all your critical documents and they're just kind of managed there. All right. So changes in the insurance marketplace.
Yeah, I think one we wanted to kind of move towards here this afternoon in closing would be just some of the stress that the insurance industry is feeling right now, specifically around liability limits, and specifically excess liability limits. And we're talking really more or less now on the commercial insurance side of things. The insurance industry as a whole has really is taking some raising some rates, and the market is beginning to harden. When we say harden, that means either rates are going up as well as underwriting guidelines are going up. And so a lot of insurance companies that were writing $5, $10, $20, $25 million excess liability limits a year, 2 years ago aren't doing it anymore. And so it's really caused and put somewhat of a pinch on our ability and really our whole strategy to transferring risk, especially larger limits of liability. And so, quite frankly, I don't even know where we would go right now for a $20 million limit, a liability limit on like a manufacturer or maybe a building or some type of exposure there. So we've had to really touch base, circle back around with legal counsel, attorneys, to get creative around managing risk and really getting creative around business structure. And so that's kind of, I think, where I wanted to maybe wrap this part of the podcast up and invite you into that discussion, Nate, with regards to some ideas that you've had around that. So when we can't transfer risk to an insurance company, we should probably look at some other structuring things to get that done.
Sure, and this is interesting because it actually dovetails with a lot of the more sophisticated business tax planning that we're doing recently to take advantage of certain code provisions that are dollar value limited in terms of their availability, and I'm speaking specifically to qualified small business stock, but that's a totally different podcast. However, we're borrowing and implementing those structures, something that's been around a long time, a tried and true approach of disaggregation of a business. And in these conversations we're having with these large enterprises and talking about disaggregation, we use, not to trademark infringe or anything, but we're using McDonald's as kind of the classic example of disaggregation and liability isolation. So they, every store is kind of its own liability remote unit, that the land's owned separately, the distributor is separate, the trademarks are separate, everything's separated within that whole entire organization. And granted, that kind of is the extreme example of it, but it's something everybody is familiar with and understands. So what we look at sometimes with business owners, the obvious disaggregation is building from business. So kind of start there. Business should be in a separate entity than building. And that allows you as an insurer, when you're looking at the building, to just focus on the building risk.
Yep.
And those can be significantly isolated. So then when we look at the business, we can look at disaggregating even a business into things like manufacture, distribution, and retail, for example. Yep. And what happens sometimes is these businesses grow up in such an organic and gradual way. They started at 30 years ago under Acme Incorporated, and they just did one thing. That could be one product or one business line. And then as time goes on, they acquire a company, bring that business line in, they develop something, and the business can grow organically, and they don't even realize. Sometimes they're not even letting you know as an insurance agent, hey, we're doing this new line of business that involves explosives. What do you think about that? And so for that, as an example, just you bring in a high-risk business line, we would view it as important as a legal enterprise, and this, in terms of accounting, it's always important to make sure that the legal, the insurance, and the accounting kind of all align But from the legal step is usually the first step of creating a separate entity, dropping that in, making sure it's got separate books and records, and payroll and all that stuff needs to be thought about. But at a very basic level, we're just taking these different business lines and dropping them into business entities that are distinct and separate so that you can now customize and tailor coverage to that specific risk, right?
Yeah, absolutely. Yeah, we really, that makes it much cleaner, especially from an underwriting perspective. But also, I think specifically, really does accomplish really a separation of assets and really keeps a corporate veil very, very clean and not pierced when you're merging different liabilities with other assets and so on and so forth. So it's a great tactic on the legal side. From an underwriting perspective and from an insurance perspective, I think what this does, going back to the point I made a couple of minutes ago, is it really allows us then to, in essence, separate the liability limits so that this particular product that they've just decided to go and manufacture
PPE.
There you go. Yeah.
Everybody's doing PPE now.
Right. Then that product poses or presents a larger liability exposure that, in essence, then, if kept in the same original corporation, would expose the rest of their products or the rest of their revenue or income to the increased exposure of just that one product. Right. So if we can peel that off into a separate corporation, insure it separately, keep that corporate veil really cleanly intact, then we can really afford to insure for less, really, any excess liability limits that we might need, because that's isolated now. And then we've also preserved the original legacy, business, which
brings down your costs on the
brings down your insurance costs, but also allows us to really get the adequate amount of liability that's needed. And that's one of the challenges that we're having right now in the industry are these high liability limits.
So Nate, when you talk about disaggregation and separating the businesses out, still under common ownership?
Yeah, usually. So
with a holding
company up top, Acme Holdings, and then you have your various divisional, and a lot of these organizations already operate in divisions. They have their, different groups, and so it's just a matter of dropping those groups into separate liability remote entities, usually disregarded entities for tax purposes. Limited liability companies is the most common for that purpose. And then at some level, you may have to update contracts and just make sure everything is on the up and up in terms of who's doing business with who for what purpose. But in the end, having that liability it's like we real estate's the most obvious example. And I think when we gave our WebEx a few months back, we kind of talked about this. Like, once you start accumulating multiple properties, you would rarely own them under the same. There would rarely be a reason to own them under the same entity, because then you're just creating potential liability bleed from one property to another. Why do that when it's just as easy to set up separate liability remote entities? And so it's just looking at your business the same way you'd look at kind of real estate investment. Is we have, this product, which is fairly innocuous, but we have this one that's a high choking hazard. We have, and they may not even be related. I see so many businesses these days who simply leverage their existing distribution channels or whatever, and they can plug almost any product into it and get it out to market. So
yeah, that's correct.
Well, Jeff, you didn't disappoint.
Oh, my.
You were
Thanks.
the star. No, this was great, and I think it's always important for sometimes these subtle reminders for these events that kind of, like I say, subtly or organically occur in our lives, and we don't take note of them until someone says, "Hey, you're underinsured," or you don't have the proper coverages you need to, or your kid's no longer driving your other 5 cars. We just need to be, I think, cognizant of those events, and when they occur, that we need to give someone a call. Great. So anyway, it's great to have you both here, and this conversation was very enlightening. I hope our listeners also took something away from it, something they can use, and with that, we'll say adieu.
Awesome. Thanks, Nate.
See you next time.
Thank you for joining us today. Hope you enjoyed the information we shared.
If you enjoyed this podcast, please feel free to share it with someone else. And join us next time.
If you want to meet with a member of the team, please contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
If you have special topics you'd like to hear about, please reach out to us and let us know at the same email address. Again, that's info@expertnetworkteam.com. Thank you for joining us and have a great day. Thank you for listening to this podcast. We want to remind you that listening to this podcast does not establish a client-professional relationship with any of the firms represented, nor does it constitute legal, investment, or accounting advice, and the views are those of the professionals only.
Investment advisory services may be provided through A&I Financial Services, and securities may be provided through Genios Wealth Management.